Lecture 22: Common and Repeated Trend Patterns. In this lecture, you will learn common and repeated trend patterns. You will learn how to recognize them and, most importantly, how to trade them professionally. Trends usually represent a change in sentiment among the investors. Almost all trends begin with a spike that consists of many strong trend bars with small tails and little overlapping. This chart here is showing an example of this initial spike at the beginning of a uptrend. This initial spike usually comes in surprise, where most traders do not expect it to happen, and therefore this spike represents a panic among those who are holding positions in the wrong direction, and also represents greed among traders who want to catch the newly forming trend. Once the urgency to follow the trend fades out, the trend becomes obvious on the chart and everyone can see and recognize it. This put the market in an inefficient situation because everyone cannot win, and for every trade to be executed, another trader must take the opposite trade. So during this phase, which is represented by this area here, several patterns might evolve, which are usually in the opposite direction of the main trend, and they are used by the market to trick traders, to keep them out of with the trend trades, and to trap them in the opposite direction. It's worth here to mention that only beginners and inexperienced traders would be fooled by these patterns, while professional traders will be waiting for such patterns to evolve so they will be able to initiate new with the trend trades at better price. There are three common patterns that are usually formed within strong trends, which are horizontal channels, flags, and triangles. Most of the time, these patterns are considered a continuation signal, and the trend will resume, and those patterns will usually break out in the direction of the main trend. However, there are cases where these patterns could evolve into trading ranges or reversals, but these cases are not the norm. So, betting on trend continuation is safer than betting on reversals, especially when the pattern followed a strong spike. The first pattern, which will be discussed here, is the horizontal channels. In this pattern, the price is usually faces a strong resistance in case of an uptrend or a strong support in case of a downtrend. Then the price pauses and will be contained within a tight channel with clear support and resistance levels. This chart here is showing an example of an uptrend that has found resistance area here, and then the price entered a tight horizontal channel as you can see here. And as it is expected, this pattern acted here as a trend continuation signal, and the price resumed the uptrend and broke the resistance line to the upside. After a second leg up, the price found another resistance area, and the same pattern evolved again, and it was also a trend continuation signal. For this pattern to work as a trend continuation pattern, the channel needs to be tight, similar to the cases here, indicating that there was no significant profit taking in one hand, and in the other hand, traders who bet usually on reversals are hesitating to take counter trend trades. The best way to trade such pattern is to wait for a breakout in the direction of the main trend to happen, similar to these breakouts here, and then to wait for a pullback toward the breaking point to be filled as a signal for trend continuation. However, traders must be cautious when trading such pattern by applying protective stop loss, because as you know, channels can break to any direction, and you must be always prepared for fake breakouts. The second pattern are the flags. Flags are very common patterns within strong trends. They are trending channels in the opposite direction of the main trend. In this chart here you can see a bull flag in this area, and a perfect entry point for trend continuation would be just here. This chart is showing another example of flags, which is a bear flag represented by this up channel here. Although this channel is going in the opposite direction of the main trend, it should be, and it is safer to be, considered a trend continuation signal. And as you can see here, the perfect entry point would be when the price breaks this channel to the downside, forming a trend continuation to the downside. Understanding this pattern is very important because most beginners and inexperienced traders are trapped by this pattern. Why? Because they see it as a reversal pattern, and in fact the opposite is true. Flags are very reliable trend continuation signals. What is striking me is that the market is using this pattern as a trap over and over again, and it works every time. No one seems to understand the trick because it has psychological basis that only experienced and skilled traders can break. The third pattern is the triangles. Although triangles have less predictive power than flags, they still are very common within strong trends, and they need to be treated as a continuation signal rather than a reversal signal. In this chart, this downtrend was paused here and formed a triangle pattern, and this pattern would give a sell signal as a trend continuation when the price breaks this pattern to the downside. However, you need to be more careful when trading triangles because they are tricky, and fake breakouts are very common within triangles. Always wait for the breakout to happen, then trade the pullback failure to protect yourself from fake breakouts. This is the end of this lecture, and in the next lecture, I will show practical examples on how you can professionally trade trends with low risk setups.